Brad, look, a lot of this global bond rally that we're seeing is making me scratch my head a bit, I have to say. When it comes to China bonds, is there further to go?
We think there is. We're not getting overly bullish, but we can see the Chinese 10-year bond heading towards the low end of its range, around maybe 2.75 to potentially a little bit lower if developed market rates stay at these low levels. It was, even though a 50 basis point RRR cut is not a massive injection of liquidity, the permanency of that move and the potential for more does signal to us that Chinese policymakers have adopted a more cautious stance with their outlook for the economy. So there is, I think, room for rates to rally further. If anything, at the very least, it's reduced the tail of tightening. So many investors that were positioned potentially for inflation in China to be higher or bond yields to rise, they're going to have to reassess their positioning. So it has removed that risk for investors in the China bond market this year.
When you take a look at the opportunities based on policy divergence, which central banks would you be looking at within this part of the world?
Well, as I said, China still stands out as one where we expect gains, not just from the yield, but from duration with rallies. Across sort of developing and developed markets globally, it does appear to us that the Reserve Bank of Australia is likely to be a laggard. We already thought they were going to be a laggard before this latest sort of lockdown in Sydney, but relative to central banks such as the Bank of Canada, the RBNZ, the Norges Bank, etc., it does feel to us that the Reserve Bank of Australia is far more focused on wages, etc. So it's a longer way away from having to talk sort of more notably about tapering or indeed tightening. So there's some potential outperformance of Australian rates relative to Canada and New Zealand, etc., and potentially a currency story there. And we haven't seen much sign of that yet, but the Australian dollar could potentially underperform some of its sort of Antipodean peers.
Brad, a couple of things going on in the U.S. that could reverberate through global bond markets, certainly in Asia. And I want to pull up a Bloomberg chart just showing the inflation. The CPI, we're expecting to get a real hot number tomorrow, already up 4.9% year over year, expected to be at least that much when we see the number for June. The break-evens, though, the 5-year break-evens, kind of have leveled off and pulled back a bit. What are you expecting in terms of the inflation message? And can bond investors say, that's a U.S. story, and it could affect the Fed, it could affect U.S. bond yields, but we can sort of put this to one side if we're heavily invested in other markets?
No, I think it's pretty hard for global investors to ignore what happens to U.S. inflation or U.S. bond markets. They are such a dominant feature. However, I do think that U.S. policymakers will, unless the number is a very significant rogue number, we'll have to look through this inflation number. We're still in a period where inflation is still high due to base effects and rebound from COVID. It's really only going to be into 2022 that we get a stronger bead on where inflation is likely to sit. In our mind, potentially the break even down at these levels, whether it's sort of 2.25 in the 10-year or towards 2.5 in the 5-year, probably time to start nibbling again. And also in markets such as Europe, where break-even inflations are very low, particularly in the 5-year. We're not expecting inflation to get back towards the ECB's target of 2% anytime soon. But there is room for inflation or break-evens to perform for global investors in European markets. So we've actually got more exposure, I guess, in European break-evens relative to US break-evens at the moment.
Do you see an improvement in appetite for corporate credit in Asia? Do you think sentiment is likely to improve?
Yeah, interesting. We've spent a lot of time this last month discussing that. The last 6 to 12 months, if you think about what Chinese policymakers have done, they don't let a good crisis go to waste. So with this strong economic rebound from virus, they have used that economic rebound to start targeting some sort of structural reforms, whether it's the 3 red lines in the property sector, getting rid of some speculation in the commodity markets, clamping down on monopolistic behaviour in the tech sector, etc. All those headwinds have created issues for the credit market. We think that those headwinds are probably peaking